And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, be sure to hit the like button below. And if you have not yet done so, please subscribe to both the podcast and to the YouTube channel. So, you think you're a good stock picker? You think picking stocks is the way to become a millionaire, to become wealthy? Maybe the data says otherwise, okay? It has been a roller coaster in financial markets over the last couple of years, right? We had Corona where things dropped off a cliff, right? Within 6 weeks of Corona hitting, markets dropped by more than a third. Then they recovered. They surged in 2021. They got smashed in 2022. And so far in 2023, things are up a little bit, they're down a little bit, they move up a little bit. It's been sort of a volatile, and we haven't really gotten anywhere. What's really, really important is that a lot of data point to the fact that a lot of the returns of the stock market come from very few amount of stocks. There's also evidence that owning individual stocks may not be the best way to secure your financial future. JP Morgan last year, I think, came out with a report, and I quote, it was titled The Agony and the Ecstasy, the Risks and Rewards of a Concentrated Stock Position. It's a report based on 40 years of data. They took data starting in 1980 and showed that owning an individual stock statistically probably wasn't such a good idea. In the report, Michael Sembalist writes, how often would a family have been better off or worse owning cash or the Russell 3000 index instead of a concentrated position? Around 40% of the time, a concentrated position in a single stock experienced negative absolute returns, in which case it would have underperformed a simple position in cash. And around 2/3 of the time, a concentrated position in a single stock would have underperformed a diversified position in the Russell 3000 index. While the most successful companies generated massive wealth over the long run, only around 10% of all stocks since 1980 met the definition of mega winners. If you were lucky enough to own one or more of those mega winning 10%, then those positions had huge returns. But hello, that means 90% of the stocks over the last 40 years were, how should we say it? Not mega winners. Okay, they weren't mega winners. You ain't getting rich on those stocks. He also writes, Sembalist, that more than 40% of all companies that were ever in the Russell 3000 index experienced a catastrophic stock price loss, which we define as a 70% decline from peak levels, which is not recovered. That's incredible, right? What does that mean, right? What do we learn from this? If you think you'll become a millionaire from owning one stock, chances are very slim that you're going to succeed. We also learn how important it is to diversify and own many stocks in order to have a few mega winners, right? Because that's what really carries the portfolio. For many investors, right, the way to properly diversify, they say, it used to be 17 stocks. I remember when I started out in the business, if you own 17 stocks in different industries and sectors, you'll be fully diversified. I think now they say that's between 30 and 40 stocks. Now, for most individual investors, picking 30 or 40 stocks is beyond their scope. They don't have the time to follow, to do the research. That's really, really hard, right, to do that. So what do we have? We have the fact that if you don't pick one of the 10% of those winning stocks, chances are you're not going to do very well. Your investments are not going to do particularly well, right? To alleviate that or to counteract that, you could, buy a portfolio of 30 or 40 stocks. Or you could buy indices, right? Just buy the stock market, right? In a nutshell. I don't want to get into the ins and outs of index funds and indices, but you can just sort of buy the market, right? The market over the last 40 years has surged, right? But for most investors investing in individual stocks, right, if they didn't hit the bonanza with those few winners, they didn't make any money, or they certainly didn't make nearly as much money as the market did, okay? How to make money? It's about asset allocation. It's definitely fun owning stocks, schmoozing about stocks over the water cooler, talking to your friends on the golf course. Hey, about this, running and speaking with your friends, hey, you know, I made money in Microsoft or I lost money in Zoom, whatever it is, right? But what's really important is creating your own personal asset allocation, your mix of stocks, bonds, and cash. It's by far and away, all the data shows, that's the single most important task for any investor, right? What do? How do you do that? You assess your investment goals, your needs, and then you create a plan which will help you achieve those aforementioned goals and needs. Then you create an asset allocation to allow you to get to that. It's really, really important to do that, okay? And then just fill it in with, again, index funds by the market, right? We'll speak about that in the future. But for most of you, it's a fool's game to try and perform as well as the market, let alone outperform the market by buying individual stocks. Like I say, right, the odds are against you. Again, 10% over the last 40 years, only 10% of stocks were mega winners. And those mega winners are what carry the stock market. So if you want to do what's good for yourself, what's good for your retirement and your financial nest egg, which is more important than having fun, okay? It's more important to actually grow your portfolio than just having fun and treading water, buying and selling stocks. Stay away, probably for most of you, stay away from individual stocks, okay? If you want to get wealthy over the long term. On that happy note, you've been tuning into the Aaron Katzman Show. We speak to you about your life, your money, and your investments. If you like this, please hit the like button below. If you've not yet done so, please hit subscribe on both the podcast and the YouTube channel. Once again, I'm the bearer of good news all the time, but seriously, no. If you want to try and grow your wealth over time, there are ways to do it and there are ways to not do it. And having fun is not always the best way to do it. Thanks so much for tuning in, and we will speak to you soon.